markets, meanwhile, we've seen a subtle recovery from, at least in the small and the mid-cap stocks. Not everything, but some odd names have started popping up. You've got price action, which is constructive, let's say, in some of those financials. You are getting a little bit of comeback, not on the Nifty, but by and large, some of the mid and small cap stocks are showing signs of promise. Parlay Mondal joins us, Managing Director and CEO with CSB Bank now. Good morning. Thank you for joining us. Let's first talk about the numbers which you have indicated for the quarter gone by, deposit growth and loan growth. How much of this is largely because of the base effect?
Good morning, Nikunj. From a base effect perspective, we have been consistently growing around 20% plus over the last few years. So to that extent, I think it's a compounding execution story which is playing out. And we hope that we'll be able to continue that for some more time. But yes, our balance sheet size is small and it works both ways. But broadly, I think what we have told in past that we'll grow faster than the system by 30 to 50% faster. I think this quarter we have outpaced that to that extent. So I think things are working for us.
Okay, so does that mean that you're likely to finish FY25 with over 25% kind of growth in terms of loan book? And what does it spell out for FY26? Can you sustain this momentum of 25% plus kind of credit growth?
So it's very difficult to predict that kind of a credit growth, but what we can say is we'll be faster than the system, as I said in past, that will grow 30 to 50% faster. Currently, of course, the systemic growth has come down a little bit closer to 12%. So I think we're outpacing that quite a bit. And also the credit growth, the bigger challenge will be how do we manage the liquidity? I think that's the larger question in the ecosystem. So deposit growth is more important than credit growth at this point of time. And hence, if we are able to sustain the deposit growth, credit growth will automatically come. I think that's the story of the whole industry as well.
Mr. Mondal, wanted to understand about your gold loan portfolio because that's outperformed this quarter as well. Can you shed some light on how the performance was in other segments like, say, retail, SME, the corporate category?
Aisha, I think what's happening for us is gold loan is a steady business for us. We understand the execution. The prices have held up in gold for a while now, and all indication says that it should sustain for a while now. So I think we'll continue to do well in gold loan for another 1 or 2 years before other businesses starts picking up. Retail, we have grown by around 33% year-on-year basis, and SME have grown by around 28%. However, on the wholesale side, we had kind of exited certain portfolio. We also ran off our DA portfolio quite a bit, the direct assignment portfolio. From that perspective, we have grown by 4% on the wholesale side, but that is one area where we'll grow significantly Q4 and in FY25 as well. And FY26 looks good for us in wholesale as well. So overall, I think credit growth is not a concern for us at this point of time. We have to calibrate it depending on how well we do on the deposit side. All our segments are doing well right now.
Not worried about the credit growth, but are you a bit worried about NIMs? Because I remember you had lowered your guidance by 20 to 30 basis points around 4.5 to 4.8%. Are you holding on to the revised one or there could be a further pressure?
I think NIM overall, the system is going through a little bit of a competition primarily because of the deposit pricing and liquidity issues. Now, having said that, we also had the issues related with penal interests are no longer allowed. So from that perspective, from a regulatory perspective, we had some impact on that on our NIMs. Overall, I think we should be somewhere close to what I guided before. 10 basis points here and there can happen depending on how the deposit cycle and the deposit pricing picks up. But broadly, I think we should be in line with what we have said in the past.
Risk which is currently building up in the system. And I'm just taking a leaf from the RBI macro stability report where they did flag it off.
You're talking about the credit costs on the unsecured side?
Yes, Mr. Mondal, I'm highlighting the fact that the RBI report did flag off that the gross net NPAs for the entire banking sector could actually go up by almost 3% for the next fiscal.
Yeah, sure. What's happening is there are 2, 3 segments where there is a little bit of a stress building up. One, of course, is microfinance, which is well known right now. On the unsecured side, also there are some challenges which is starting to come up. And once we have seen that once it happens on the unsecured side, whether it is credit cards, personal loans, business loans, it starts touching the entry-level MSME as well to that extent. So I think broadly it is happening in the retail area, and that's why you're seeing the retail growth starting to taper down a little bit, especially in the unsecured and microfinance space. So I think that will play out in the next 3 to 4 quarters. But I don't think the problem is so deep that it will create a long-term sustainable problem. So it should, get corrected on its own in the next 3 to 4 quarters. But in the interim, yes, there could be some challenge on the retail side of the NPA. Other parts of the portfolio, I think at an overall systemic level is pretty okay. For us, unsecured book is very small. MFI book is relatively small. So it will not have a major impact for CSB.
Okay, point taken. Just a quick last question. Since you're talking about there could be like interim pressure, does that mean that the asset quality wherein your GNPA was around 1.68% could worsen a bit in Q3? And you stick by the ROE guidance that you'd given of around 1.5 to 1.8%?
I think we should hold on to our guidance, what we've given in past. We have always said that we will have a GNPA less than 2%, NNPA less than 1%, and credit cost less than 40. I think we'll be significantly lower than that. I don't see too much of a movement on what our current numbers are at this point of time on all the 3 parameters, give and take a few basis points here and there. And to that extent, I think from an ROA perspective, we have given a guidance somewhere closer to 1.5%, closer to 1.5 rather than 1.8. But over the next 3-4 years, we'll be between 1.5 to 1.8. So we should be able to hold it somewhere close to that, in my view.
Mr. Mondal, on that note, we'll let you go. Appreciate you joining us for a quick conversation today. But
if you like this video, then like, share and subscribe to ET Now.